a horrible session. Red all across the board, in the end down by 1.3%. Doing the most amount of damage though was the financial space. Every single stock in the financial sector, excluding property, was lower. There was not one that traded high today. Some of the big losses were Covermore down by 5.7%. We also saw Macquarie down by 3.7%, but that stock was trading ex-dividend. And even some of the big banks, Westpac, ANZ down by 2.5% and Commonwealth down by 2.1%. So some heavy losses in that financial space. And of course, if we have a look at the sell-off, it was across every single sector on the market, but it was mostly the big end of town. The top 20 lost 1.6% today. That's compared to mid-caps as well as small caps, which fared relatively well. Mid-cap stocks were down by 0.9%, and the small ordinaries index was actually down by 0.5%. So the big end of town sold off heavily, a lot of the financials being sold off, and of course BHP Billiton being sold off given the spin-off of South32 as well.
Yeah, we're going to talk about still long the banks, or do you think near term there's more pain to come?
I like the banks at these levels, to be honest. I mean, I think there's three layers you need to look at when you are looking at the banks. And first of all is the global layer. We know that the yield trade has been attractive, and we know that over the last month we have seen bond prices moderating and yields rising. This is simply a demonstration of what happens when people try and jump off the boat at the same time. We know that the yield trade has been one of the most popular trades around, and when people are unwinding bond positions like that, we've seen the impact of that in terms of asset prices. However, I don't think that interest rates are going to rise rapidly around the globe. I still think we are in a low inflation, low growth period. So while we see volatility in terms of bond assets as well as equity assets, especially some of those high yielding assets, I don't think the yield trade is totally dead. Secondly, from an industry level, if we have a look at the banks, we know that they're exposed to the housing market. There's been talk of more capital requirements on the banks as well, and that's having an impact. And we know there's extra competition because we've just heard from the banks during their reporting season that there is extra competition for those loans as well. And then I guess from an investment level, May is always quite a weak month for the banks, and that's because 3 out of the 4 banks pay their dividends. Well, they go ex-dividends, so they're trading without the dividends at the moment. So I think those 3 layers are the ones that investors need to be aware of. I think from a global level, I don't think the yield trade is dead. Secondly, from the industry level, I think the banks are looking oversold at the moment because of the rapid decline that we've seen over the last month. So from a short-term perspective, we're looking for a little bit of a bounce there. And thirdly, just from an investment perspective, look, 3 out of the 4 banks have gone ex-dividend. May is typically a weak month for the banks, and we usually see a bounce back in mid-June.
And within that, Julia, do you need to be judicious about which banks you decide? Do you see them offering different things to investors?
Well, the banks all do tend to move together, so there is a high correlation there. However, from a valuation perspective, they are quite different. So I guess that my preference in terms of valuation, from a valuation perspective, would be Westpac or NAB. But of course, in terms of share price appreciation, Commonwealth Bank has been the clear leader there. They're also different from their strategy point of view. Commonwealth Bank and Westpac have a big chunk of their business in terms of the domestic market. So if you are worried about the domestic housing market, you're probably going to be worried about Commonwealth Bank as well as Westpac the most. And then NAB, of course, has its UK assets, and ANZ has its Asia strategy as well. So a difference in terms of strategy, a difference in terms of valuations, but in terms of share price movements, there does tend to be a high correlation on how the big 4 move.
Right, moving on to Julia, South32 moving forward?
I mean, if you have a look at the share price action, it was a pretty volatile day. It opened at $2.13 at midday. It hit a high of $2.22. And then it hit a low of $2.01, so just above that $2 mark, and it finished near the lows at $2.05. So it was an okay debut. It wasn't a fantastic debut, and for BHP shareholders, I think there were a lot of hopes that perhaps it would lead to a re-rating of BHP Billiton, but BHP fell by $2.36 today, so it fell by more than the South32 amount. If we have a look at South32, most of the valuation of South32 comes from its aluminium assets and manganese. And if we have a look at the aluminium assets in particular, aluminium's up about 5% over the past 52 weeks. I guess the most attractiveness of aluminium in Australia is though the Aussie dollar. The Aussie dollar is actually down 14% over the past 52 weeks. So if we continue to see that weakness in the Aussie dollar, I think South32 will continue to do quite well. And the aluminium market is looking much better than it has in years. We've seen Alcoa as well as Rio address some of the supply-demand imbalances in the market, so getting rid of some of the supply. So the market's in a lot more balance than we have seen in a number of years. So I wouldn't be surprised to see Rio Tinto try and offload some of its aluminium assets as well. So that's one to keep an eye on.
All right, look, on that